Welcome back, my friends. If you follow this channel, you probably already know that this week is a big week for Q3 earnings call. In particular, Meta, Alphabet and Pinterest are all scheduled to report Q3 earnings this week. And, as you also already know, online ad spending is weakening substantially. Online ad spending is the lifeblood of many big tech companies. And, we have already heard some unofficial warnings from the CEOs of Google and Meta. So, will this week's earnings calls bring more clarity and clearer warnings? Actually, I think so, and I also think that Wall Street analysts are looking for signs of either collapse or recovery in online ads. Snap reported Q3 earnings last week and it was not pretty. Snap's Q3 earnings call set an ominous tone, telling the world that online advertisers are decreasing their marketing budgets. The online ad pie is shrinking while there is more competition from TikTok for fewer ad dollars. We know what that meant for Snap in Q3. But, what does it mean for Alphabet, Meta, and Pinterest? As well as Amazon and Microsoft. What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Wall Street analysts are bracing for some version of disaster in online advertising. Snap set the stage with disappointing Q3 earnings last week. Shares in Snap fell 28% plunge following their disastrous Q3 earnings call. That is the lowest Snap shares have been since the start of 2019. Now up to bat are Alphabet, Meta, and Pinterest, with Amazon and Microsoft on deck. Twitter also reports Q3 earnings this week in what could be their last public earnings call. The plethora of earnings calls comes as Wall Street analysts are extremely skeptical of the online ad market. You probably already know that shares in Meta platforms are down 60% in 2022 and 75% in the past 12 months. And Wall Street analysts are expecting another decline in revenue from Meta. Shares in Google parent Alphabet are down 30% in 2022. Analysts expect single-digit sales growth from Google, which, I suppose, is better than a revenue decline. This is the weakest period in Google history, financially speaking. The United States is teetering on the brink of recession. And consumers are tightening their spending. So, corporate marketers are reining in spending. And, if you follow this channel, you already know that Apple's iOS privacy policy change is punitive on ad-supported tech companies. That is particularly the case for Snap and Facebook, rely heavily on user data to target ads. Sentiment in the online advertising space has softened of late, a UBS analyst wrote in a report last week. There are more anecdotes of budget cuts as well as advertisers holding back some budget in hopes of a 4Q flush, the analyst continued. Looking into 2023, we think planning amidst this level of macro uncertainty sets the stage for below-consensus growth in 2023, even if macro does not significantly deteriorate from here, the analyst continued. We are reducing estimates and price targets across the online advertising group, the analyst also added. The weak macroeconomic environment and strong US dollar are weighing on growth and earnings. Our checks with digital ad agencies reveal that many advertising directors are pulling back certain budgets, particularly among smaller advertisers, the UBS analyst continued. Snap confirmed that a number of factors are hurting results, including platform changes, macroeconomic challenges, and competition. Just as in its Q2 earnings call, Snap refused to provide forward guidance. We are finding that our advertising partners across many industries are decreasing their marketing budgets, Snap said. This is true especially in the face of operating environment headwinds, inflation-driven cost pressures and rising costs of capital, Snap continued. The Q3 earnings report from Snap could herald dismal results for its big tech peers. Meta, Twitter, Pinterest, and Google all reported disappointing Q2 earnings. Shares in Pinterest were down 6% on Friday, probably because Wall Street is anticipating a disastrous earnings report. Following Snap's brutal Q3 earnings call, shares in Twitter fell 5%. But, the price of Twitter stock will not matter if Elon Musk closes the deal to buy the company. Meta and Alphabet have built multifaceted digital ecosystems that dwarf the smaller Snap, said Jim Cramer, host of Mad Money. So, they are more immune from weaker digital ad spend, Cramer continued. And, as I am sure you all know by now, Elon Musk is expected to close the deal to buy Twitter. Musk has until Friday to finalize the acquisition of Twitter or else stand trial. If you recall, he made the offer to buy Twitter earlier this year, but then waffled on the deal. Twitter sued Musk in a Delaware court to force the purchase. Twitter shareholders approved the deal last month. Musk then confirmed his intent to close the transaction at the original price of $54.20 per share. Twitter is making sure that the financing is confirmed before dropping the lawsuit. Shares in Twitter are hovering around $50, which means that investors are still not entirely convinced the deal will close. Meanwhile, Twitter has been struggling financially. Wall Street analysts are anticipating yet another decline in Twitter revenue for Q3. Meanwhile, Elon Musk has said that he will fire 75% of Twitter employees when the deal closes. Twitter reports Q3 earnings later this week. Amazon is something of a stickier advertising platform than Meta and Snap. That is primarily because it is mainly for shopping and only secondarily for advertising. So, if retailers are pulling back on ad spending on Facebook and Snap, they might not on Amazon. Sellers need to maintain brand visibility, and Amazon is the largest e-commerce company. It is probably necessary for sellers to pay the Amazon platform. But even the kingpin Amazon is suffering from slowing growth. The pandemic was a boom time for online businesses. Now comes the hangover of slow growth, maybe permanently. Shares in Amazon are down 28% so far in 2022. Microsoft let go of additional workers as revenue is expected to slow, thanks to weaker sales of Windows licenses for PCs, said a Microsoft spokesperson. Tech companies big and small are getting in on the act of cost-cutting. Salesforce is on its second layoff this year, and it is now the target of an activist shareholder. Meta Platforms is rumored to be cutting 15%, which some analysts think is not enough. Netflix seems to be hitting a ceiling and has started layoffs. By now, almost every major tech company has stopped, slowed, or reversed headcount growth. It is fair to say that Q2 earnings were weak or weakening in most companies, aside from oil companies. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. Google and Meta Platforms reported decidedly disappointing Q2 earnings. Meta has begun quietly pushing out a significant number of employees. Analysts expect these reductions to be a precursor to deeper cuts. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.